welcome to the FII View with me, Tanveer Gill. My guests today on the show are Steve Brice, Chief Investment Strategist at Standard Chartered Bank. He joins me from Singapore. And Kenneth Lowe, who's Portfolio Manager, Matthews Asia, joins me from London. Matthews International is a growing emerging market dedicated fund which has overall assets of $25 billion. The fund that Kenneth oversees or manages is the Asia Growth and Income Fund, which is $4 billion in assets under management. Thanks very much once again, both of you, for joining me today on the show. Let me begin by getting your India view, Kenneth. Given that this fund is Asia dedicated mostly, I see that your India allocation is at 2.5%, which is way below the benchmark MSCI weightage to India. Why are you so underweight on India?
Well, what we're trying to achieve within the portfolio is very high quality companies bought at a valuation which we think is incredibly appealing when you compare it to what we think the intrinsic value is. And we're looking for that alongside sustainable growth. Now, India, in a lot of ways, has both the quality companies and a lot of the sustainable growth we're looking for, but valuations has been a little bit of a sticking point for us when we look at what we're trying to achieve on a 5 or a 10-year view.
Kenneth, how has your view on India changed post-elections? What has the view meant for India allocations?
It's actually not had any impact on allocation per se. We're very much bottom-up investors, so we're looking company by company. Now, what I would say is clearly having a political mandate like this is very interesting and potentially very exciting, but we haven't seen what the actions will be yet, and we haven't seen what the implications for individual companies are yet. And we'd rather wait to see some of that take place first, rather than getting caught up in the euphoria.
Fair enough, but is your long-term view on India bullish?
I wouldn't say we want to make a bet on that. We don't tend to make bets, but if we start to see things like infrastructure investment take place, start to see some of the fiscal imbalances shift backwards and reducing the fiscal deficit, if we start to see maybe the state-owned banks be recapitalized, which I think we need to see for that investment cycle to take place, then these are all the incremental things we're looking for to get a little bit more interested and excited. And hopefully, when they come to fruition, we'll also find companies at a bottom-up level which are well priced to take advantage of that.
Steve, let me get in your views. Post the strong election mandate, what is your take on India's growth over the next 1 or 2 years? Do you see India returning back to 7% plus growth?
I think we'll see actually probably a return to above those sort of levels over the longer term. If you look at the fundamentals in India, outside of the sort of cyclical weakness, I still think they're very positive. I think demographics, for instance, are still a huge positive for the Indian economy. And if we start getting reforms through to help liberalise the economy and allow it to achieve its potential, 7% is very easy to achieve. So, the key uncertainty in the market is the path to getting there. Will we see that over the next 6 to 12 months? Probably not. But will we see it over the 12, 24-month period? We believe yes. And that's obviously a positive environment.
Steve, RBI recently stated that there is room for easing policy stance if disinflation happens faster than expected. What is the kind of rate cuts that you're expecting from the RBI over the second half of this calendar year?
To be honest, if we get anything, I think it's going to be very limited. I think, really to see inflation coming down over that time horizon, we'd need to see dramatically lower food prices. Obviously, we've got the monsoon season coming up, so that's going to be a key uncertainty. But we're not looking for anything dramatic from the RBI over the short term. I think key over longer term will be the government policies that are employed to try and reduce inflationary pressures from a structural perspective, and therefore give the RBI scope to ease monetary policy. And I think that's where it gets quite interesting. We're expecting retail industry to be liberalised significantly. That should reduce inflationary pressures and therefore help reinvigorate growth from a lower interest rate perspective.
Kenneth, I'll come to you. I mean, what is your biggest concern with regards to India? For emerging market dedicated funds such as yourself, which is growing as well, you would perhaps be one of the lowest allocations to India at this point that I have also come across among foreign funds. Is the rating on India under review?
I wouldn't say it's a big worry, but as a market, you've seen historically quite aggressive flows from foreign investors into it. And the very high quality companies that exist there tend to be aggressively bid up. And in our view, you see a lot of overpayment which is taking place. So I really struggle with paying 30 times earnings for good quality businesses, because ultimately price is what you pay and value is what you get.
Yeah, your India investment right now stands at $80 million roughly on a fund size of $4 billion. I'm just very inquisitive to know, how much of the incremental flows coming into the fund are you looking to invest in India, or is it status quo?
we're always evaluating what bottom-up ideas look like, and as the market turns, as the investment cycle begins to show itself in India going forward, I would expect that yes, we will find more ideas at that bottom-up level, but right now they don't exist for us. We're continually looking and evaluating them, but I wouldn't say there's a huge amount of money that's getting put to work incrementally within India.
Steve, let me get your thoughts on what you expect from the Indian budget as challenges still remain on the fiscal front. What's your view on fiscal consolidation, the path that the government may adopt going forward?
Well, I think it's going to be, it's going to be interesting how the government addresses this. First on their list is probably going to be to try and focus on making sure everybody understands the situation we're in now is due to the previous administration rather than from their perspective. And then obviously going on in terms of saying, okay, how can we raise taxes to help address the sluggish tax receipts that we've seen. One of the issues they're talking about is obviously trying to address the flow of money out of the country in tax evasion or avoidance schemes. So trying to address that. How they actually affect that, that's very complex actually to do. Even very few countries are successful in doing that, but if they manage to address that, that should bring down the fiscal deficit quite dramatically. But overall, we do expect the fiscal deficit to go on a downward trend. And again, that should be quite a positive environment.
Right. Steve, I just asked Kenneth this, but I'll repeat the question. I mean, Indian equities have hit fresh record highs every single day, and it's been a record run for the markets 15 days post-election results. Do you see foreign flows into Indian markets continuing both in the debt and the equity segment?
I think at the structural level, because of the reform environment we're expecting going forward, yes, I'd expect significant foreign flows to continue going into Indian markets. In terms of Indian equities at the moment, I think they're looking obviously very bullish over the past 2 months and even since the beginning of the year. From our perspective, though, it looks very overbought from a technical perspective. I think the last time we were at these sort of overbought levels was 2 or 3 years ago. So it suggests that maybe market's getting a little bit ahead of itself, and we could see the market pull back before consolidating and moving higher again.
Kenneth, when it comes to India, the rally recently from February lows has been led largely by banks, cyclicals, energy, materials, the high beta sectors essentially, which you're avoiding as part of your fund strategy. You're more bullish on telecom, consumer staples, IT software for that matter. Is that the reason why you haven't scaled up investments in India?
Mm-hmm. We tend to look for domestic demand-oriented companies. Now, the banks clearly are domestic demand-oriented, but they do have some issues, particularly the public sector banks. They are undercapitalized in my view, so they need to see some capital injections take place. And I don't think they're quite priced for that. So we don't tend to look at the cyclical so much in places like energy and materials. I think in the banks you have that issue. So we're looking at things which are in places like consumer discretionary and consumer staples. We just are yet to find those companies that have a balance of quality, value and growth.
Kenneth, Indian financials have done really well. Private and PSU banks have had a very, very impressive run over the last couple of months. And there's talk of restructuring the PSU banks into holding companies. A lot of suggestions are being deliberated, to overhaul the entire sector. What is your view on Indian banks? They seem as safer bets than banks in the rest of Asia, or you do not subscribe to that view?
The short answer to that would be not really. I do think there's some asset quality issues that exist within them. Now, they may well be surmountable, but ultimately you have NPL ratios which are fairly high and restructured assets which are also incredibly high. And we need to see that asset cycle or the NPL cycle take place to understand what the loss given default is going to look like and how much capital needs to be injected to repair that financial system. If you look in other parts of the region, the credit cycle is at different stages. And we can find some very, very high quality balance sheets that exist in places like Singapore, for example, where you have tier 1 ratios that are very high. You have loan to deposit ratios which still look pretty decent as well. So capital and liquidity looks a little bit better, certainly capital looks a little bit better elsewhere in parts of the region.
Kenneth, let's talk about the IT sector. Now, they have been laggards really to the market's rally so far. What is your view on the Indian IT space? Do you have conviction holdings in the sectors?
Is it hot or not? It's something that we have looked at in the past as a potential investment. There's some very high quality companies there. It's something we don't own today. I would say that currency is probably the biggest question mark on most people's minds as to how that's going to impact if we do see economic recovery and we do see the rupee strengthening. What kind of implication does it have for the exporters? To me, it's more about the FX volatility, and if you have a lot of volatility, that hurts the IT service guys. I think they can cope with a slightly stronger rupee, and there might be some interesting things they can do domestically as well. If you do see bank restructuring, they'll be the first guys as port of call to do some of that IT service work. So I think on a medium-term view, they still have some interesting growth levers.
The other one, of course, that's being talked about is the energy space. It's seen as a sector that could potentially re-rate with reforms. Do you see an opportunity for refiners such as Reliance Industries or an ONGC for that matter, or even some of the oil retailers?
Broadly speaking, right across the region, we don't spend a lot of time looking at the energy sector because we like to own businesses that have control over their own destiny. And not only are you very heavily regulated, but you also are thrown around by energy prices that you really don't have very much control over at all. So for us, it's about finding good businesses that can dictate their own future rather than investing in these kind of incredibly high cyclicals, which might be a short-term trade for some people.
Stephen, I'll come to you, and I want to talk to you about the currency as well, because that's important for foreign investors too. It has extended its gains, the local rupee. What's your view on the currency from a 6 months to a 1 year perspective? How do you see flows impacting the currency? And also, how do you tie in that view with what may happen as far as the US is concerned if rates were hiked in 2015?
I suppose, again, over a longer term, those flows should be rupee supportive. I think our key concern in the short term is this re-evaluation of US interest rate hike risks. As I say, we're looking for the first quarter of 2015 for the first rate hike. The market's currently looking for NQ3 2015 or NQ4. So that is a significant difference of opinion. Wage growth in the States did pick up in the latest data. We do expect inflation to pick up. And then against that environment of a strong dollar, we may well see the rupee give up some of its recent gains. So the big picture, yes, the rupee looks protected, but we're probably going through a bumpy period in the interim.
Fair enough, Steve. What about your sector calls? What are the sectors in India that you are overweight on or underweight on, respectively?
Well, our key area for overweights are the industrials, and also if you look at the utilities, they also look very interesting. Clearly, the increased infrastructure spend that we're expecting to come through from this new authorities should help bolster both of those sectors. So those are the two areas that we really like within the Indian equity space.
Kenneth, I want your opinion on the currency as well, because it's an important variable for you too. Do you see the rupee gaining more from here?
We don't have FX expectations. We're very much a bottom-up, fundamentally driven house, so we don't like to bet on currencies per se. So I'm kind of loath to give you an answer as to where I think the rupee is going in the short term. What I would say is when we do our bottom-up work, we're trying to work in what the worst-case scenario might be for that to understand what our margin of safety is within businesses we're investing in.
All right, Stephen, Kenneth, let's talk about your China and your broad EM view then. Kenneth, come to you first. Why the big overweight on Hong Kong? I mean, your investments in China are also pretty extended, but you have a really big overweight on Hong Kong. What's the reason behind that?
The overweight is actually primarily Hong Kong. Now, as I said at the outset, we're looking for high-quality companies, and that means things like strong balance sheets, good management teams, excellent track records, competitive advantages to keep sustainable returns going, high returns going. And we look for good governance standards. So all of those things lead us towards countries like a Hong Kong, where we consistently find good quality companies with some interesting growth prospects at valuations which aren't too onerous. In terms of mainland China, we actually don't have that much direct exposure there at all. So it's predominantly more of a Hong Kong weighting than it is a mainland China one.
But what's your opinion as far as China stocks are concerned? Is the weakness in the Chinese market a sign of uncertainty, or is it a function of the fact that the worst has been factored into the market, so it could be a contrarian buy?
It's an interesting question. I think this year is a tough one for China. And it may well be tough for the foreseeable future because you're trying to balance off a gradual deleveraging within a financial system that is clearly geared up quite aggressively in the last 5 years. And you're balancing that deleveraging against or with reform, and that's against keeping full employment and keeping minimum GDP growth levels. So when you're looking at the balancing act between those four things, it's quite difficult, and it's going to be interesting to see how committed the government is to that reform process to get more sustainable growth going forward and focusing more on the quality of it rather than the quantity.
Steve, how do you read the recent data points coming out of China? They've looked encouraging, especially the export numbers. What's your view on China's economic growth and what impact it could have on commodities and global growth for the year 2014 and going forward?
Well, I think the way we've been pitching our views on China, for instance, are that we see China becoming less of a negative, but certainly not a significant positive for global growth. If you look over the past 15 months, we've seen growth expectations for this year come down from 8% to 7.3% from a consensus perspective. Now, we don't see it going down much further from here. Indeed, it's been stable around 7.3 now for 5 to 6 weeks. So from our perspective, the recent data is totally in line with the fact that the economic surprise index was, until recently, at global financial crisis lows for China, and we expected the authorities to partake in some sort of easing of policy, and obviously we saw more of that evident yesterday. So overall, I think that the data is going to be stabilising and maybe improving slightly in the short term, but we don't expect a strong bounce in the Chinese economy. So, as I say, it's going to be less of a negative going forward.
Kenneth, your fund has done well in this market, despite the fact that you have a big underweight and perhaps you missed out on the rally in India. There has been decent exposure to relatively stable and well-performing markets like Japan and Australia, which I think have been supporting your overall performance. Are these long-term allocations under review right now, or you're pretty much going with your sector and country allocations? You're pretty much sticking to what you have been following over the last 6 months?
Well, again, we don't have allocations necessarily. What we're looking at is individual companies by companies, and the holdings that we have in markets like Australia, Singapore, Japan, those more developed countries, we still very much think are attractive from a risk-reward perspective when you're thinking out 5 years or 10 years. Australia is a very interesting one because, again, like Hong Kong, we find a lot of very high-quality businesses that are trading at interesting multiples.
Also, Kenneth, I'm just inquisitive. How are you looking at the India versus China trade right now? I would imagine that there would be more favor towards India, given the fact that the demographics are favorable, as well as there's a new government that's taken charge, so expectations are riding high. From your portfolio, it seems that you clearly favor China. So how do you kind of position yourself on that trade?
There's definitely a lot of euphoria that's taking place. I hope that that reform path is followed through, and I hope that they're successful within doing that and boosting a GDP growth rate and not throwing away the demographic dividend that they have in hand. But we don't look at it in terms of saying, look, the demographics in India are fantastic and the reform profile is looking better, and in China the reform profile is looking reasonable too, but the demographics aren't as strong. We don't look at it as trading those two things off against one another. It's about finding those bottom-up interesting ideas, and right now, as I say, we still find some more of those in places like Hong Kong, Australia, Japan, Singapore than we do in India.
Steve, I want to talk about growth with you as well. What's your view on Asian economic growth at this point, and how do you compare India versus its Asian and emerging market peers on macroeconomic parameters? Do you think that India is better placed compared to its peers?
I suppose we had until recently seen a lot of pessimism around India, and we'd been warning that people not to get excessively pessimistic because the chance of when the tide turned in terms of reforms, that would be very positive for Indian equities. We're neutral Indian equities within an Asia context, but looking for an opportunity, which the market's obviously not providing for us at the moment, to go overweight. So we believe that the election result is extremely important. That will lead to a better economic environment ultimately. It will take some time to get there, so we're looking for that opportunity to go overweight.
Kenneth, given your overall view on China, do you think that the China slowdown is still a big risk for the rest of Asia, including India, that perhaps it could potentially derail the exuberance and excitement that there is for some of the other growing Asian markets?
I think as it stands, the China slowdown has been fairly measured, actually. We still see private sector profitability growing reasonably. We still see wage growth that is in high single digits, low double digits, filtering through the economy. So actually, as a measured slowdown taking place in China, it's, I don't think, a huge potential ramification for the rest of the region, actually. And you can see that in individual companies that are still maybe domiciled outside of China, but still growing their China numbers fairly well. So if you're well placed as an individual company, I think you can tap into that wage growth, which has been pretty consistent. Now, if we were to see some kind of credit event, which I don't think is likely, then of course there would be some more knock-on implications for the rest of the region.
What about the risk of low inflation prints in China? Could that be a key risk for world markets, which have been seeing a rally all throughout into the middle of this year? Do you think that's a concern?
I don't think it's a huge concern at this point. As I say, when you're looking at kind of bottom-up inflation in terms of wages, that's still growing fairly healthily and fairly substantially. So I think that's almost as important a metric to be looking at as CPI would be.
Steve, talking about world markets, what is your view on the recovery that we're seeing in developed markets like the US and Europe? Do you see DMs outperforming emerging markets on growth parameters? And, if that's your view, then do you see DM equities outperforming EM equities this year?
Well, certainly we have a preference for US and European equities over the coming 6 to 12 months. And I think the key issue here is we see, because the growth is accelerating, particularly in the US, recent data in Europe has been fairly lackluster, but obviously the ECB is trying to address that, is that we have much greater corporate earnings transparency in terms of what we're going to see in the coming months. So the US has been outperforming expectations from an earnings perspective for some time. Europe did in the first quarter. Obviously we need to see that's going to be cemented, but overall that leads us to be very favourable on US and European equities. Asia should still do reasonably well, but we still expect a little bit of underperformance. Corporate earnings really still quite lackluster in the big picture relative to expectations.
Sure. Steve, then what's your specific view on oil? We have seen oil rebound post impressive China export numbers and the macro data, which has been improving. How do you view oil prices going forward?
Well, we're still overweight energy within a neutral commodity allocation. And the reason for that is I think the risk reward is there. We're not actually looking for stellar gains for oil prices over the course of the next 6 to 12 months. But we just feel there's more visibility on demand starting to pick up, and that should help support oil prices. So not hugely bullish, but probably a slight positive tilt going forward.
Also gold, has slipped recently. Your view on gold and how you see the dollar strength impacting gold prices, because year to date gold prices have been a bit depressed. Well,
I think you've hit the nail on the head in terms of dollar strength. I think that's going to be something that we're going to see more. We're expecting the US Federal Reserve to hike interest rates much before market expectations. So we're looking at Q1 2015. We do believe that's going to support the dollar. Also, if you're looking at rising long-term yields against that backdrop, but also, as importantly, still strong equity market performance, the opportunity cost of holding gold is going to be very significant. So we're still underweight gold and bearish. We still believe that we're going to break through that 1200 level ultimately, and that is going to obviously lead to negative returns over the course of the next 6 to 12 months.
Fair enough, Steve. Kenneth, before we wrap up, I just want your final word on India and how it stacks up amongst emerging markets because of your strong underweight position there. Do you subscribe to the popular opinion that India, in its investment profile right now, with the new government taking charge, is perhaps looking a lot better than other emerging markets? Or are you viewing this rally as a cyclical bull market and not a secular one?
I think that remains to be seen. It will be a secular bull run if we see execution taking place on this reform path. We can lay out a number of those steps, but they need to be seen out. And that's the only way, I think, which you can be committed to saying that it's a secular bull run. And the same is true for saying it's cyclical. We just don't know yet, and we need to see some action take place first before you can form a real opinion.
Fair point, Kenneth. Thanks very much, Steve and Kenneth, for joining us with your views on the market, on India and the rest of the emerging world. With that, we come to the end of this edition of the FII View. Thanks very much for watching the show.